Hello, ladies, and welcome to the Debt Reduction Calculator live example, where I'm going to show you how to use the spreadsheet that I referenced in Module 4, Getting Rid of Your Debt. So this is a spreadsheet that I found out on the internet, and it was created by Vertex 42, which is a company that has several different spreadsheets out there. But I really like this debt reduction calculator because it's very easy to use, and you can go through and select different scenarios to really show you how quickly and how quickly you will pay down your debt, as well as how much money you will spend over the time frame that it takes you to pay down that debt. So here you can see the website is here that you can click on, and you can go out to the website and you can re-download this spreadsheet, or you can download Google Sheets. It has a version in Google Sheets. This is in Excel. I normally use Excel, but you also can use it in Google Sheets if you're not an Excel user. So I'm going to go from the beginning, and I'm going to show you how to walk through and enter your creditor information, your balance, your interest rate, as well as your payment. And we'll get into what the custom category is a little bit later. So I'm going to start with creditor. And instead of putting specific credit card companies here, I'm going to use credit card number one or car loan number one, just so that I don't have to specifically name any creditors and confuse anyone. But your credit card could be your Visa, your MasterCard, whatever you call that debt or whatever you call that payment item that you're paying each month. You can absolutely put that here so that you know specifically what you're entering and what it looks like. So for this debt reduction calculator, I'm only going to put the debt that are some of the quicker things to pay off. I'm not going to do anything like a mortgage on here. You absolutely can add in the mortgage. I have it added onto mine because I wanted to see how long it would take me to pay off all of my debt plus my mortgage. But my goal for getting out of debt only includes my credit cards, my car loans, and my student loans, because getting my house paid off is in another step further in the future for me. But you're welcome to do it any way that you feel will fit in with your goals. So the first thing you want to do is enter in the date that you want to start your debt pay down, your debt reduction, or the date that you go out and get all the final balances for your debt. So if today, say for instance, if today is July 1st and I'm going out and looking at all of my debt and getting the balances that are outstanding, which means the total balance that is still left to pay on that debt, then I'm going to put that date in here because that's the balance date. So we're going to start with July 1st, 2020. And in the creditor column, this is where you put the name of the debt that you want to pay off. And so I'm going to put credit card number one here, the total balance that I have left to pay on my credit card. And this is if I had the cash to pay it down to a zero balance. That would be $2,500 for this credit card. The interest rate, or the annual interest rate that you would pay on this credit card, you can call and get that, or you can log onto your account online and get what that interest rate is. You can also look on the back of your credit card statement. You'll see something that says APR, and that would be your annual percentage rate for the year. And you would take that amount and you would put it here. So I'm going to assume that it's 27%. If you have a credit card for a store, or like a store in the mall, usually that percentage rate is going to be on the higher end unless you get a lower introductory rate. And a lot of those rates are going to range between 21 and 29%, depending on the store. Some stores will give you a credit card for the store at an introductory rate, and that can range from 0 to 5 to 10%. And it's usually for a shorter period of time. And what they want to do is they're trying to entice you to get a card for their store, give you a low or no introductory rate. And they're hoping that you come back later and spend more money with them. And then that's when they'll be charging you that higher interest rate, because that's really how they make their money outside of the profit on the items that they sell in the store. As far as the payment, this is the minimum monthly payment that is on your statement or on your credit card bill that you receive, it says this is the minimum amount that you will have to pay each month to avoid a late payment penalty or insufficient payment penalty. So I am going to enter that I pay $55 a month as my minimum payment on this credit card. And I will go over this custom area shortly, so I won't forget about that. And then you can see here the interest only column. This shows you the interest portion that you pay on this $2,500 at a 27% interest rate for the year. So you really have to be careful on your interest rate. As you can see, this costs you a lot of money. And then here, the creator of the spreadsheet has put information in here, basically explain to you what the column is. And the reason why you see it in red is because it's telling you that your minimum payment is not enough to cover reducing your balance as well as paying the interest that's charged on this credit card. So that's a good flag. That will help you determine if you need to pay more on that credit card so that you can start knocking down that balance. Because what you'll notice, if you are paying less a month than the interest that's accruing on that balance, then you're basically not paying down that balance at all. And every month when you get your credit card, you probably notice that the outstanding balance is creeping up because you're going to have about $1.25 that's going to be added to the principal balance or the total balance of that credit card. And then the next time you get your statement, you're going to have $2,501.25 times the 27%. So just keep an eye on that when you get your statements and make sure that that's not an issue that you're running into. The second item that I'm going to add is car loan number 2. And this car loan has a balance of $18,000 at a 7% interest rate. And my monthly balance on this on this car loan is $500. That's my monthly payment that I pay on that car loan. Car loan number 2, and I apologize. I meant to say car loan number 1 here. Car loan number 2 has a $9,000 balance with an interest rate of 6%. And my monthly payment on this car is $250. The next item on my list is a credit card. This is credit card number 2 for me. It has a balance of $5,000 with an interest rate. Here I'm putting 21%. It's a little bit lower than the first card I had. I'm assuming that the first card I have on here is going to be a store card for me. And the monthly payment for this credit card is $90. And then I have student loans. And my student loan balance is $55,000 with an interest rate of 6%. And my monthly payment on this is going to be $375. And I have student loan 1 because my husband also has student loans, and I could add that in as student loan 2. Because we pay all of our debts together. And let's say he only has $1,000 left on his at 3%. And we pay $120 a month on his. So you can see here, this has totaled up all of the debt that's outstanding. So it shows that you have $90,500 in debt that you want to pay off. And the total minimum monthly payments that you make on these accounts are $1,390 a month. So my first thought is, looking at this, I don't like that this is in red. I don't like that I'm not paying off the interest every month on this credit card, because that means my balance is going to keep creeping up and I'm really not going to make any traction with that credit card. So I'm going to go in, and even though my monthly payment is $55 a month per the credit card company, I'm going to change it to $60. So that way I know that I am paying off, I am paying down, eating into the balance every month. And then that's not going to cause my debt to increase. So the monthly payment that you want to make is $13.95, and that's the minimum payment on all of your credit cards. I mean, all of your debt, your credit cards, your car loans, your student loans. That's the minimum payment that has to go out of the door so that you will not get a penalty on that month's payment. So if you can pay more than the $13.95 a month, then in your monthly payment box, this is where you want to enter that amount. So now if you only have $13.95 a month because your budget is really tight, then you put $13.95 here. And that's how much you pay a month, and that's it. And you're solid in that stance, then you go on to the next line, which is your strategy line. So here we have different drop-down options. We have the Snowball Method. We have the Avalanche Method, which we talked about. Then there are 4 other options in this table, which I will go in high level, but I really think that you should choose either the Snowball Method, which you pay your lowest balance down first, or the Avalanche Method, where you pay your highest interest rate first. If you wanted to pick how you wanted to pay your debt off and not follow either of these methods, then you can go through here. And if you really have a passion about what you want to pay off first. So say for instance, this car loan here, the customer service is digging into you every month, calling you. Even though you're paying on time and everything, they're really giving you a hard time. And every time you call them, you just get so frustrated. And if you really want to pay that off first, then you could put a number 1 here. And then you want to get rid of that credit card. Next, you can put 2 here. And say you're getting tired of having student loan debt. You can say, I'm going to pay my husband's loan off first. I'm going to pay my loan off next. And then I'm going to pay this credit card off. And then finally, I want to pay this car loan off. If you have a passion for how you want to pay it off and you don't want to follow the Snowball or the Avalanche Method, you can come here and choose custom. So if you choose custom highest, it's going to detail out how you should pay off your debt based on the highest number. So your highest number here is 6. And so that's saying you need to pay off the car loan of $18,000 first. But because you knew when you filled that out, you wanted to get rid of that car loan first, you would pick custom lowest first, and it's going to put number 1 first, which is that car loan number 2 that's giving you that hard time. And this shows what that would do to your debt payoff in that order. So let's go back to the Snowball Method, and I can show you a little bit more in this section here on how the different methods impact your payoff amount, as well as the timing of when you'll pay it off. So when you choose the Snowball Method and you're only paying $1,395 a month, which is the total minimum payments that are required of you a month, then it's going to cost you $23,763.40 to pay off all of this debt by May 2027. So basically, you're going to pay all of this debt off in 7 years, but the interest that you're going to pay on this debt using this method and not throwing any extra money to your debt is going to be $23,000. So let that sink in for a minute. So that's how much being in debt is going to cost you if you're paying the minimum payments every month, according to the schedule. Okay. So let's say you wanted to do the Avalanche Method instead. And this is the method where you are going to pay off the debt with the highest interest rate first. And again, what that does is it saves you money over time because you're going to pay that principal off that is costing you the most money. And the great thing about this spreadsheet is you only really need to enter your information in once, and you will only need to change it if, say, your minimum monthly payments changed or your interest rate changed or something happened and your balance changed. Say if you spent money on a credit card that wasn't in your plans and then you have a different balance or an updated balance, you can put that here. So that's the great thing. This really doesn't ever have to change unless there is a specific change that you need to enter. So you can go between methods at any time, and you can change your methodology of paying it off, or you can go through and experiment with each of these and it will show you the total interest that you'll pay over time and when you'll be debt free. So let's say we change it to the Avalanche method. So here you would see that it is putting your higher interest rate debt at the top. So you can see here, credit card one was 27%, which is pretty high. Then your next one, credit card two, is 21% of the balance, which is pretty high. And so it's telling you that you're going to pay that off first. Okay. So here you're going to pay $23,763.40 over that time. So let's see how that changed. Interesting. That did not change for us. I wonder, is it because our balances are not that different? Let's look at this one. So when we choose custom high first, you see how your total interest changed. Now you're paying $26,751 over the time frame, and you're out of debt in August 2027. If we do custom lowest first, you're paying $27,743, and you're out in August of 27. So let's go back and let's just make sure that we can get this to change. So let's say you have a little bit extra money in your budget and you can pay $1,500 a month instead of the $1,395. So here you see that your initial snowball is the 105. So that's going to be the difference between the $1,500 that you can pay versus your minimum payment. So it's taking this $105 and throwing it at this debt to help you get out of debt faster. You can see that your interest rate is a little bit lower over time, and you're out of debt earlier because you're throwing more money at that debt. Let's try to change it to the Avalanche method. So see here, you see that it did change this time, and it's because you're throwing more money at the highest interest debt. Let's go back and just make sure that it is less. Yes, so it is slightly less, which is great. I thought the spreadsheet was broken for a second, but it's working as it should. I think just the interest rates and the amounts that I chose were very similar. So because we're paying the minimum payment the whole time, it really didn't change much. But the great thing is here you can see that the Avalanche method does save you money over time. I currently use the Snowball method, and that is because I like to cross my debt off once it's paid. I like to see that I've knocked things out. I'm that type of person. My personality is pretty much a perfectionist, analyst. And so when I can see that something's been knocked off my list, that makes me extremely excited. So I like using the Snowball method. So now I want to show you that how, if you decide that you have, or if you get extra money one month and you just want to use that extra money one time to pay down your debt, how you can see that in your analysis. So one, you have to make sure that the Snowball method is chosen if that's the one you want to go with. On the second tab is a payment schedule. And you can see here, this breaks out by month what paying down your debt looks like, when you would pay a specific debt off. So you'll see here, your student loan payments will be $225. Let's make sure that that is right. Student loan payments number 2. And I'm using, the lowest balance first is the student loan, which is $1,000. So that's right. So here it shows that you're paying $225 a month on the student loan payment. And if you pay that amount per month plus that, let's go and make sure. So yes, that $225 includes the $105 additional that you're paying every month and the minimum payment of $125. And so this is what you're paying every month, this $225 here. And you will see that you will be out of debt with this student loan December 2020, and your last payment would be $106.93. Okay, so then what you would do is you would take that amount that you were paying over, which was the 105 plus the 120, and you will now add that to your minimum payment for credit card number one, which is going to be the $60. So you're basically paying $60 plus that 225 that you were paying, and you will start then knocking out that credit card number two. Okay, so let's say in January you received a holiday bonus. So after the holidays, you were given a bonus in January of $1,000, and you wanted to put, let's say you wanted to put $500 of that towards your credit card payment to help get it, to help knock it out faster. You would come in here, and for January 2021, you were enter $500 here. And you can see it added a $500 payment for just one time to the credit card. So that month you would pay $785 versus $285. Now, what I want you to see is how it changed for your payoff. So let's go back in and take it out. And you would see your payoff is in October 2021. Your last payment is $79.45. However, if we come in here and add $500, you see that you would pay that credit card off 2 months ahead of schedule, which is great. And then that will also trickle down to when you will pay off everything else. So you can see here, it reduces the total amount of interest you pay over time, as well as when you would get out of debt. Okay, so let's just give you another example. Say you get a mid-year bonus, and that mid-year bonus is a little bit higher because sales were really good that year, if you're a salesperson, and you pay $1,000. You see, again, it reduces when you pay things off. You get out of debt a month earlier, and you spend less over time. So anytime that you get extra amounts of money, you enter it wherever you're going to make that extra payment, and it automatically adjusts. It also gives you a snapshot here. You don't always have to go back to the front, but I wanted to show you that because you were familiar with that. It gives you a snapshot here of each debt that you entered into your spreadsheet, and it changes based on you entering data in this yellow column here when you want to pay it off. So this is a great tool for you to use to manage your debt. And once you do it one time, you can come in anytime and change it. There have been a few months where I was really busy and I didn't get to track my extra payments that I made. And so after a couple of months, I came in and updated it all, and everything was updated, and I was right back on track. For everything that I just showed you, if you wanted to see what it looks like with the Avalanche method, you come here. It already adjusts everything for you. It tells you when you're going to pay it off. You can see the student loan was there first for the Snowball method, but now the credit card is in there because that's the one with the higher interest rate. Let's change this payment here so you got your taxes back. And let's say you got back a really good tax return. You put $5,000 towards your debt. You can see how it changes. It shortened your time period for paying certain things off. And you can see here, saved you money. It was $19,000 before, now it's $17,000, and you're out of debt a little bit sooner. Instead of August 2026, now you're out of debt in April of 2026. So I hope that was helpful. If you have any questions, reach out to me and I can absolutely help you with entering in the data, working through extra payments in your spreadsheet. I just want to make sure that you feel really comfortable with the spreadsheet, and the way you set it up has motivated you to pay off your debt. So thank you again for watching this video, and I hope it's helpful. Again, reach out to me and I will help you if you need assistance. I just want to make sure you have the confidence to go for it and get out of debt so that you feel free and on your way to financial freedom. Talk to you soon. Bye.